Is NIO stock about to skyrocket to $8? That's the big question on everyone's mind after the latest developments in the EV market. With shares down by over 20% since September, some analysts are now betting on a massive recovery for NIO, while others warn it could be another trap. Today, we'll break down the data, analyze the latest news, and explore whether this EV giant is ready to make a comeback or if it's destined to stay grounded. Also, if you're new here, don't forget to subscribe for the latest stock updates and exclusive insights. First, let's talk about why NIO stock has taken a hit. Since the highs of September, NIO has been struggling with declining sales momentum and overall market weakness in China, which is their biggest market. But here's the key. The decline has also been influenced by external factors. China's economy has been sluggish, and while recent government stimulus efforts are expected to inject over $100 billion into the market, that impact hasn't fully kicked in yet. But there's more. Tesla's aggressive price cuts in China have forced NIO to re-evaluate its pricing strategy to stay competitive. Tesla's move has sent shockwaves through the Chinese EV market, and for NIO, the challenge is maintaining its premium positioning while keeping prices competitive enough to attract buyers. This tug-of-war between profitability and market share has created a lot of uncertainty, and that's reflected in the stock's recent performance. NIO isn't just sitting on the sidelines. One of the most significant changes in its strategy has been the launch of the Anvo L60 SUV, which is being touted as a lower-cost alternative to Tesla's Model Y. This move is part of a broader shift for NIO, as it looks to balance its premium models with more affordable options. The Anvo L60 has already seen strong initial sales, and it's one of the reasons why some analysts are predicting a potential price surge for NIO. Additionally, NIO has made a bold decision to end its free battery swapping services, a move that has sparked controversy among customers but is aimed at improving the company's margins. While this might hurt short-term customer satisfaction, the long-term goal is clear. NIO wants to cut costs and improve profitability, which is essential for any stock to see sustainable growth. With battery as a service still in play, NIO is betting on its ability to create a recurring revenue model from this unique feature, which continues to set it apart from competitors. While NIO faces challenges at home, it's not backing down from global expansion. The company has set its sights on Europe, launching the Firefly brand in 2025. This new brand will focus on smaller family EVs, a segment that's in growing demand across Europe, with Germany and Norway being key markets. NIO's strategy here is to leverage its battery technology and unique ownership model to carve out a niche in an increasingly competitive landscape. This international growth will be critical for NIO to diversify its revenue streams and reduce its reliance on China, which has been subject to both economic slowdowns and regulatory risks. But there's a significant hurdle. NIO will need to scale production rapidly to meet demand, all while navigating complex European regulations. The Firefly brand could be a game changer if executed properly, but any delays or missteps in production could undermine these efforts. At this point, you might be wondering, why should investors be paying attention to NIO right now? The answer lies in the next earnings report. This is a make or break moment for the company. Investors are watching closely to see if NIO can improve its margins, hit its delivery targets, and continue to roll out new models. The stock's performance will likely hinge on how well NIO navigates the challenges we've discussed. Here's what you need to watch: the sales data for the Anvo L60 and the progress of NIO's international expansion. If these two areas show strength, we could see significant upside in the stock's price, potentially bringing it close to the $8 mark. Now, let's dig into the stock prediction itself. Can NIO really reach $8 in the near future? Some analysts certainly think so, with price targets as high as $15 over the next 12 months. But these optimistic forecasts are based on the assumption that NIO can successfully execute its international expansion and continue to innovate in areas like battery technology and autonomous driving. On the flip side, the bearish outlook points to ongoing production issues, increased competition from other Chinese automakers, and the lingering effects of China's economic slowdown. There's also the question of profitability. NIO isn't expected to turn a profit until 2026, which means there's still a long road ahead for the company to deliver consistent financial performance. What could drive NIO's stock higher in the short term? One potential catalyst is a major partnership announcement or new product launch. NIO has been hinting at a new sedan, and any further details about that model could reignite investor interest. Additionally, any improvements in China's economic outlook could lead to a rebound in NIO stock price. The Chinese government stimulus package is expected to help the broader market, but its full impact has yet to be felt. Another factor to watch is NIO's upcoming technology developments, particularly in autonomous driving. With Tesla leading the charge in self-driving tech, NIO will need to show that it can compete in this space. Any advancements here could give the stock a significant boost. So, what's the bottom line? Is NIO stock about to skyrocket to $8? It's possible, but it's also highly dependent on how well the company executes its strategy over the next few months. NIO's strengths lie in its innovative technology, strategic shifts toward affordability, and its plans for international expansion. But the challenges are real: competition, production issues, and the reliance on a shaky Chinese market. For long-term investors, NIO could be an attractive play if you're willing to ride out the volatility. But for those looking for more stability, the risks may outweigh the rewards at this point. Here's something else to consider. NIO's financial position isn't as strong as some of its competitors. As of their latest financial report, NIO still has significant cash burn, driven by their high spending on R&D and expansion efforts. This means that while NIO has great potential for future growth, it also faces the risk of needing to raise more capital, which could dilute current shareholders. Investors need to weigh whether NIO's aggressive expansion is sustainable without continued funding. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. Moreover, NIO's focus on technology innovation, like its autonomous driving initiatives and continued development of its battery-as-a-service model, shows that the company is not just trying to compete in the present, but is positioning itself for the future. But these technologies take time and money to develop. Investors who are bullish on NIO will need to be patient as the company refines its tech and moves closer to profitability. What's your take? Is NIO a buy, or are the risks too high for your taste? Drop your thoughts in the comments, and if you found this analysis helpful, don't forget to like and subscribe for more. Thanks for watching, and I'll see you in the next one.